What are working capital lines? Working capital lines are any lines that you can tap into for your business to grow or for emergencies. So really they are broken down into two categories, I like to call them. First is a line of credit. A line of credit is for people that have more established businesses that are doing at least $30,000 to $40,000 a month going into a business bank account. They've been in business at least a year, usually two. They have really strong credit profiles and credit scores, and those are going to be a little bit longer. They're going to be 6, 12, 18, or even 24 months. They have simple interest, meaning they start at really 6% simple interest and they go up from there based on how well you score out in a risk assessment. Now, the other type of working capital lines are working capital advances. These are advances based on the revenues of your business, and these are a lot easier to qualify for than a traditional line of credit. Businesses use these all the time for growth or if an unexpected expense comes up. Now, why are they so popular? Well, they're popular because they're easier to get. You can usually get them in 24 to 48 hours. You can get them with minimal documentation. What do I mean when I say minimal documentation? Typically, 6 months of business bank statements, an application, a driver's license, a tax return, and proof that you own the business. That could be your articles of incorporation, it could be a tax return, and then if you accept credit cards, they're gonna ask for the last 3 months of your payment processing statements. And basically, they are shorter term financing or shorter term advances that are usually anywhere from 6 to 18 months, but most fall into that 6 to 12 month category. And what is distinct about these types of programs is they either have Monday through Friday payments or they have weekly payments, so one payment a week. And the other type of payment they could have is their payment is a fixed percentage of your credit card sales. These programs are a little bit more expensive than a line of credit. They should, if you use them or you are thinking about using them, you should always ask for a prepayment option, a prepayment discount. And all that means is that if you take the money out, and let's just say it's a 12-month advance, and you decide that you can pay it in 4 months, you should be able to save money, and that's why you want to have that prepayment discount or prepayment option built into it. And most lenders, they don't offer it, but if you ask for it, they will put it in there, and that is a huge little inside secret. Now, why would you use expensive money? Well, you would use expensive money, these working capital lines, if you have an opportunity to make more money in the business, or you need it to pay off. Let's just say you have a big tax bill coming up and you have to pay that, or you have a lien or a judgment, you have to pay that. But ideally, they should be used for growth. If you're using one, you want to always calculate a few things, and this is really, really important to understand. If you're paying, call it $200 a day, and let's just say there's 21 payments in a month, you're going to be paying close to $4,200 a month. If you're using those funds for growth, let's just say for marketing, you want to make sure that your revenue is going to increase more than the $4,200 a month. Why is that important? Because then you're not operating at a cash flow deficit. The other thing is, let's say on that same example I just gave you, getting advanced $25,000 to pay back $33,000. So it's going to cost you $7,000 if it goes full term or the full time and you don't pay it off early. In that example, if you're using it for marketing, are you making more money than the $7,000 you're paying? Because that's important too. If that $25,000 is going to cover the next 6 months of marketing, right? And you know that every month that you have your marketing campaign going, you're going to make an additional $5,000 a month. Well, at the end of it, you're going to make an additional $30,000 that you wouldn't have, and you're going to pay $7,000 for that opportunity to make the $30,000. Well, guess what? You actually have $23,000 that you didn't have if you didn't move forward on that working capital line. If you can get a line of credit is going to be way cheaper, and you obviously should get a line of credit. However, if you don't have 650 credit, or if you don't have the right time in business, or you don't have the right cash flow, and you don't qualify for the line of credit, but you do qualify for the advance, that working capital line, and it's still going to be profitable and it's still going to help your business expand, you absolutely should do that. The other thing that you should do is, if you're going to take the advance, you should make sure that you are taking the necessary steps that you need and that your business needs to get into that range where next time you can get that line of credit. So many businesses fall into this trap and this cycle of continuously taking these advances and not actually working on the reason why they got declined for a line of credit in the first place. If it was your credit, you should go to credit repair. We have the right partners for that to help you get your credit up that are reputable and will do the right job. If it's time in business, there's really nothing you can do except make sure you make it to that mark. So if you're less than 2 years in business and that's why you didn't get the line of credit, you're going to have to use the advances until you hit that mark. If it's cash flow, my suggestion is make sure you always have enough cash flow in there. Typically for a line of credit, they're going to want to see $2,000 to $3,000 in the bank account at all times, right? For an advance, it's not as important. It's important, but it's not as important. Make sure you're always improving your business and putting yourself in a position to get better financing in the future. But working capital and the working capital lines can be used to get inventory, supplies, equipment, consolidate some debt, even though I don't recommend it for that. As long as you are using it for business growth and the thing that you're using it for is going to bring in more than what the payment is and it's going to be profitable for you, you're going to net, you're going to increase what you're making by using financing. That's the metrics that you have to monitor and really pay attention to. Because if you're growing the business and putting your business in a better position to thrive and to get better, then the next time around, hopefully you can either get a line of credit or an SBA loan, or if you use it for equipment, hopefully this time around you can get equipment financing. Always want to see what the opportunity is to grow your business using working capital lines, and then try to, if you didn't get the best program available, see what you can do to improve your business, put in the work to get your risk score down and get into that better program. Always look. I mean this. Like the businesses that I see that thrive are the ones that are always trying to improve. And it's really breaks down to improving your credit, both business and personal, improving your cash flow, increasing your sales, increasing your profit margins, and making sure you always have cash in the bank. I hope this helped. If you have questions, go to integratedbusinessfinancing.com. You could ask us live and we will get right back to you.